Welcome back to the deep dive. Today we're probably going to ruin your day.
A little laugh. That's one way to put it.
No, okay, that's not fair. We're going to ruin the way you look at the cash in your wallet, but hopefully by the end of this, we're actually going to help save your financial future.
It's a bit of a take the red pill moment, isn't it? It's uncomfortable at first, but once you see it, you just can't unsee it.
It really is. And to guide us through this matrix, we're diving into some fascinating material from the Wealthnetic world, and specifically some viral insights from a creator called Raf Paraway.
Right.
And the core topic is something that sounds almost like a magic trick, but it's really a global economic reality. It's called the money illusion.
And it's probably the single most important concept to grasp if you want to understand why working harder and harder doesn't really feel like it's paying off anymore.
Okay, so before we get into the heavy stuff, the graphs, the history, I want to start somewhere that seems completely unrelated.
Okay.
I want to talk about chickens.
The chicken paradox. I love this. It's such a perfect starting point.
It is, right. So the source material brings up this incredible comparison. If you go back, say, 50 years to the 1970s, how long did it take to raise a chicken from a little chick to, a full-size bird for the supermarket?
Back then, you were really at the mercy of nature. It took about 6 months, maybe 5 if you were really good at it, but basically half a year to produce that chicken.
6 months. 6 months of feeding it, housing it, waiting. Now, fast forward to today. We have genetic science, climate-controlled environments, scientifically perfect feed. The source calls it fast and furious breeding.
Right.
So how long does it take now?
About 45 to 60 days. 2 months, tops. It's incredible.
It's absolutely insane. We've become 3 times more efficient, 300% faster at making food. And it's not just chickens, right? It's everything. Corn, computers, cars. Technology is this massive deflationary force. It makes things easier and cheaper to produce.
Absolutely. And in a logical world, if you can make more of something faster and cheaper, the price should go down. It should plummet.
If I can make 3 chickens in the time it used to take to make 1, chickens should be dirt cheap. They should be practically giving them away at the grocery store.
But they're not.
They are not. And this is what drives me crazy every single week. I look at the price of chicken breasts or eggs or really anything, and the numbers only go one way, up.
So there's the paradox.
Exactly. Technology is pushing prices down with all its might, but there's this other force, this invisible hand that's pushing them up even harder.
And that something else is the whole story. It's the key. It's not that the chicken is getting more expensive. The chicken is still just a chicken.
So what is it?
It's that the money you're using to buy the chicken is becoming worthless. It's dying.
And that right there is the money illusion.
That's it. It's a cognitive bias. It's a trick our minds play on us because we see the dollars or the euros in our account, and we think of them as a fixed unit of measurement, like a ruler.
Right. An inch is always an inch. A meter is a meter. If I measure my desk today, and I measure it again in 5 years, it's going to be the same length. We just assume a dollar works that way.
But it doesn't. Imagine if, someone snuck into your house every night and just shaved a tiny, tiny sliver off your ruler.
I'd go crazy.
You would. You'd measure your desk in a few years and you'd say, wow, my desk grew. It used to be 3 feet wide, now it's 4 feet wide. My desk is appreciating in value.
But the desk didn't change at all. My ruler just got shorter.
That is precisely what's happening with inflation and money. You think your house went up in value. You think that chicken got more expensive. In reality, the money shrank.
Wow. Okay.
The source material uses this brilliant mental image. Imagine a graph with 4 lines on it over the last 50 years.
Yeah.
You've got the US dollar, maybe your local currency, food prices, and the price of gold.
Okay, I'm picturing it. 4 lines.
If you ask anyone on the street to draw that graph, they'll draw the money lines as flat, right? Because a dollar is a dollar. And they'll draw the food and gold lines shooting up to the moon.
Because that's our lived experience. Stuff gets more expensive.
But the source argues that is the illusion. To see reality, you have to find the real anchor. The line that is actually the flat one is gold.
Wait, gold is the flat line? How can that be? The price is always going up.
The price in dollars is going up. But think about what gold is. It's a physical element. It's been a store of value for 5,000 years. The amount of effort it takes to dig 1 ounce of gold out of the ground is relatively constant over time. Its value, relative to other real things, is incredibly stable.
Okay, so if we accept that gold is the stable baseline,
Then you have to invert the whole graph in your mind. If gold is the flat line and the number of dollars needed to buy it keeps going up, What does that say about the dollar?
The dollar line is crashing. It's going down.
It's in a nosedive. All the currency lines are. And here's the real kicker. The food line. Relative to that flat line of gold, the real cost of food has actually gone down.
Okay, you have to walk me through that again.
Because of that fast and furious chicken technology we talked about, it takes less human effort, less energy, less real resources to produce a chicken today than it did in 1970. So it actually takes less gold to buy that chicken.
So the chicken got cheaper in real terms.
Yes. But because the currency you use has crashed even faster than technology has made things cheaper, the price tag you see in the store is still higher.
So it's a race. We have technology fighting to lower our cost of living, and central banks printing money, which raises it.
And for the last 50 years, the predators have been winning. Hands down.
That's a deeply unsettling thought. It means the savings account, I think, is my solid ground is actually, what, quicksand?
The source used a great boat analogy. You're on a boat, which is your cash savings.
Yeah.
You're looking at an island in the distance, which is all the stuff you want to buy, a house, a car, a comfortable retirement. And it looks like the island is rising up and floating away into the sky. But islands don't do that.
My boat is sinking.
Your boat is sinking. And you're mistaking the sinking of your boat for the rising of the island.
Okay, so if the boat is sinking, who drilled the hole? I mean, it can't have always been this way. My grandparents always talk about when a nickel could buy a Coke and a movie ticket. Was there a specific moment where the rules of money just changed?
There was. There was a very specific day, a specific decision that changed everything. We have to go back in time to August 15th, 1971, the Nixon shock.
I've heard that term, but honestly, I feel like most people, myself included, just sort of nod along. What actually happened that day?
So to understand 71, you have to rewind just a little bit more to 1944. World War II is ending. Europe and Asia are in ruins. The Allied powers get together in a place called Bretton Woods, New Hampshire, to basically design a new financial operating system for the entire planet.
And the U.S., having won the war and being physically untouched, they're in the driver's seat.
Completely. And critically, they had all the gold. They held something like 2/3 of the world's official gold reserves because everyone had been paying them in gold for weapons and supplies.
So they had the leverage to set the rules.
Exactly. So they proposed a new system. It was simple. All the other world currencies, the pound, the franc, the mark, they would all be pegged to the U.S. dollar at a fixed rate.
Okay.
And the U.S. dollar, in turn, would be pegged to gold at a fixed rate of $35 per ounce.
So a dollar was basically just a paper receipt, a claim check for a tiny piece of gold.
It was as good as gold.
Yes.
That's the whole point.
Yeah.
Any country could, in theory, show up at the U.S. Treasury with 35 of their paper dollars and demand 1 ounce of physical gold in return.
And that keeps the system honest, right? Because the U.S. can't just print a bunch of new dollars if they don't have the gold in the vault to back it up.
That was the anchor. That was the discipline. But then the 1960s happened.
The Vietnam War.
The Vietnam War. And at the same time, President Johnson's Great Society social spending programs at home. The U.S. government was spending a phenomenal amount of money, way more than they were taking in through taxes.
So they had to make up the difference.
And they did it by printing money. They
Right.
started printing way more paper dollars than they actually had gold in Fort Knox to back them up. They were basically writing checks that they knew would bounce if everyone tried to cash them at once.
And the rest of the world started to notice this.
Oh, yeah. They weren't stupid. Countries like France, their President de Gaulle was very vocal about it. They looked at the numbers and said, wait a minute, you guys are printing like crazy. We don't think you actually have the gold anymore. We'd like to cash in our paper dollars now, please.
It was a classic bank run, but on a global scale.
A global bank run. You had countries literally sending warships to New York Harbor to pick up their gold. The U.S. gold reserves were just pouring out of the country.
So Nixon had a choice.
A terrible choice. Option 1. Stop the spending, stop printing money, raise interest rates, and trigger a massive, brutal recession to defend the dollar's peg to gold. And probably lose the war in Vietnam. Or option 2. Change the rules of the game. Default on the promise.
And a politician is never going to choose a recession, especially not during a war.
Never. So on that Sunday night, August 15th, 1971, Nixon went on live television and announced to the world that he was temporarily suspending the convertibility of the dollar into gold.
Temporarily. That might be the biggest lie in modern economic history.
We're still in that temporary period more than 50 years later, and that was the moment. That was the day the anchor was cut. The dollar, and by extension all world currencies, became what we call fiat currency.
That's cut. What does that mean?
It's from the Latin, let it be done. It means money that has value simply because a government declares that it does. It's not backed by a physical commodity like gold or silver. It's backed only by faith in the government that issues it.
And once you're not tied to gold,
The printing press can run forever. The limit was removed. And if you look at any chart of any major economic problem we face today, debt, inflation, wealth inequality, they all look like a gentle slope until 1971. And then they go vertical. It's the hockey stick moment for everything.
okay, that makes perfect sense for why the US dollar is sinking. But, we have listeners all over the world. The source material we're drawing on is from a Thai creator talking about the Thai baht. So why is this a global disease? If the US is being irresponsible, why can't other countries just opt out and say, no thanks, we'll keep our currency sound and stable?
This is maybe the most counterintuitive and, frankly, the most insidious part of the whole system. This source calls it the export trap. It's a mechanism that basically forces every other country to import America's inflation, whether they want to or not.
An export trap. Okay,
Right.
break that down for us. Because normally you'd think having a strong currency is a good thing, right? If I live in Thailand, I want a strong baht.
Well, yes and no. If you're a consumer who buys imported goods, yes. A strong baht is great. Your vacation to Europe is cheaper. The new iPhone is cheaper. But if you are a producer, if you own a factory that makes things and sells them to other countries, a strong currency is your worst nightmare.
Why is that?
Okay, let's use the example from the source. Let's imagine a factory owner in Thailand. We'll call him Mr. Somchai. He owns a factory that makes rubber tires, and his biggest customer is Ford Motor Company in Detroit.
Okay. Mr. Somchai, the tire mogul.
So all of Mr. Somchai's costs are in his local currency, the baht. He pays his workers' salaries in baht, he pays his rent in baht, his electricity bill is in baht,
Right, his expenses are local.
but his revenue, his income, comes from Ford in US dollars.
Yeah.
Let's say he sells a tire for $100.
Simple enough.
Now, let's say the exchange rate is stable at 30 baht to $1 US. So when he gets the $100 bill from Ford, he takes it to the bank and he gets 3,000 baht. Let's say his cost to make the tire were 1,000 baht. He's made a 2,000 baht profit. He's happy. His workers are employed. Everyone wins.
The system is working.
Now imagine the U.S. Federal Reserve decides to print a few trillion new dollars to, I don't know, stimulate the economy. That massive flood of new dollars weakens the dollar's value on the world stage. So suddenly $1 isn't worth 30 baht anymore. It's only worth 20 baht.
So the baht has become stronger relative to the dollar.
Exactly. But look what happens to Mr. Somchai. He still sells his tire to Ford for the same $100. But when he takes that $100 bill to the bank now,
He only gets 2,000 baht.
he only has 2,000 baht.
Yeah.
His revenue just dropped by a third overnight. But his costs are all still 1,000 baht. His workers haven't taken a pay cut.
So his profit just got wiped out.
It's completely gone. He's now losing money on every tire he sells. He's going to go out of business. He'll have to fire all his workers. The entire export sector of the Thai economy, which is huge, grinds to a halt.
So what does the government do? What does the Bank of Thailand do?
They panic. They cannot let their entire export industry collapse. So the head of the central bank says, we have to weaken our currency. We cannot let the baht get this strong against the dollar.
And how do you deliberately make your own currency weaker?
You print more of it. You run the printing press just as fast as the Americans are. You create baht out of thin air to buy dollars, flooding your own country with baht to push its value down and keep it in line with the sinking dollar.
That is it's completely twisted. It's a race to the bottom.
It's called competitive devaluation. When the country with a global reserve currency, the U.S., devalues its money, it exports that inflation to the rest of the world. It forces every other central bank to play the same game just to keep their own economies afloat.
So we're all tied together, sinking on the same life raft.
And that's why if you look at a chart of, say, the euro versus the dollar, they kind of dance around each other. They look relatively stable. But if you zoom out and chart all of them against a real asset like gold,
They're all crashing in unison.
they're all going down together. And the person who pays the ultimate price for this game isn't the factory owner or the government. It's the average person, the saver. The person holding cash whose purchasing power is being systematically destroyed to keep this export machine running.
This brings up the official inflation numbers, because we're always told, inflation is at our 2% target, or maybe it spikes to 3%. But anyone who actually buys their own groceries or fills up their own car knows that feels like a complete fantasy.
It is a fantasy. Or, to be more generous, it's a heavily massaged statistic. The official number, they quote the CPI or Consumer Price Index, is a metric the government created. And critically, it's a metric whose calculation they can and do change whenever it becomes inconvenient.
So how do they fudge the numbers? What are the tricks?
Well, there are a few big ones. The first is called substitution.
Substitution.
Yes. So if the price of a nice cut of steak goes up by, say, 20% in a year, the government statisticians will just assume that you, as a rational consumer, will stop buying steak and switch to cheaper ground beef. So in their official basket of goods, they take steak out and they put hamburger in. And then they turn around and say, see, your food costs barely went up at all.
But my quality of life just went down. I'm eating burgers instead of steak. I'm poorer.
Precisely. They're not measuring the cost to maintain your lifestyle. They're measuring the bare minimum cost of survival, and they adjust the goalposts constantly.
Yes.
Another one you see everywhere is hedonic quality adjustments. This is for things like electronics. They'll say, well, yes, the new iPhone costs more, but it has a better camera. So adjusted for quality, the price actually went down.
That's absurd. I don't have a choice to buy last year's model.
Exactly. And then there's the one we all feel every day.
Shrinkflation.
Ah, yes, the incredible shrinking chocolate bar.
Right. The price of the bag of chips stays the same, so the CPI records 0 inflation. But the bag quietly goes from 10 ounces to 8 ounces. You're paying the same for less product, which is a very real form of inflation that the official numbers often miss. I swear my cereal boxes are basically two-dimensional now. There's no depth to them anymore.
The source material suggests that if you really want to see the truth, you should ignore the CPI completely. Instead, look at the chart for the money supply itself. Look at a metric called M2.
M2? Sound like a James Bond gadget. What is it?
It's just a broad measure of the total amount of money in the system, all the cash, all the checking accounts, savings, deposits, everything. And if you look at a chart of M2, especially since 2008, it hasn't gone up by 2 or 3% a year.
How much has it gone up?
It's gone up by hundreds of percent. It's an almost vertical line. And it's just simple logic, right? Supply and demand. If you massively increase the supply of money, but the supply of actual goods and services in the economy stays roughly the same.
The price of everything has to go up eventually to absorb all that new money?
It has to. It's just math. But there's a lag, there's a delay between the printing and the price rises, and that delay is what's so dangerous because it lulls everyone to sleep.
Let's talk about that delay. The source draws a really interesting comparison between two massive economic crises to show how this is all speeding up: the 2008 financial crisis and the 2020 pandemic.
Yes, the fast-forward effect.
Yeah.
This is a crucial piece of the puzzle. So in 2008, we had the subprime mortgage meltdown, the hamburger crisis, as the source calls it.
Right.
And the Federal Reserve responded with something new called quantitative easing, or QE, which is really just a fancy academic-sounding term for creating money out of thin air to buy toxic assets from the big banks.
And I remember back then, a lot of people were screaming about hyperinflation, the dollar's going to collapse, buy gold!
They were. And they were right in principle, but they were early. Gold did go up, but it took a good 3 or 4 years to really hit its peak.
Yeah.
And consumer prices, the stuff you buy at the store, they stayed surprisingly low for almost a decade.
Why was that? Where did all that new money go?
It got stuck in the financial system. The Fed gave it to the big banks, and the big banks used it to speculate on Wall Street. It flowed into the stock market, the bond market, real estate in New York and London. It didn't really get to Main Street.
So it created asset price inflation, but not consumer price inflation?
Exactly. This is something called the Cantillon effect. The people who are closest to the money printer, in this case, the banks and the super rich, they get the new money first. They get to spend it before it is circulated and cause prices to rise. By the time that money trickles down to the average person in the form of a small wage increase, prices have already gone up.
So they're always one step behind.
Always.
Yep.
That was the 2008 model. But then 2020 was completely different.
The pandemic.
With COVID, the government didn't just give the money to the banks. They did something unprecedented. They helicopter dropped it directly onto Main Street.
Stimulus checks. PPP loans.
They sent checks directly to people's mailboxes and bank accounts. Trillions of dollars. And what did people do?
They spent it immediately.
Immediately. On Amazon, on new cars, on home renovations, on cryptocurrency. That money hit the real economy like a tidal wave. And so the inflation didn't take 4 years to show up.
How long did it take?
About 18 months. We went from the Fed telling us there was zero inflation and it was all transitory to official numbers hitting 9% in the blink of an eye.
So the whole cycle is accelerating.
It's speeding up dramatically. The system now requires bigger and bigger injections of printed money just to keep from collapsing. And the inflationary side effects are hitting faster and harder each time. The source warns that whatever the next crisis is, the response and the subsequent inflation will be even faster.
It's like a drug addict who needs a bigger dose each time just to get the same high.
That is a perfect analogy.
Yeah.
And they can't stop. If they were to stop printing and actually raise interest rates to where they should be, the whole mountain of debt that the world is built on would collapse. So they are trapped. They have to keep printing.
This is a pretty grim picture. I feel like we're all passengers on the Titanic, and the captain is on the loudspeaker telling us the iceberg is just a transitory supply chain issue.
Lavis. The structural integrity of the hull remains strong.
Exactly. So, okay, let's pivot. This is the deep dive, in the Wealthnetic style. We don't just admire the problem, we try to find a solution. The source material is extremely clear on this. The single worst thing you can do is nothing.
Cash is trash. That has to become your mantra. If you are saving for the long term, for retirement, for your kids' education in a cash savings account, you are guaranteeing that you will lose. You are actively choosing to get poorer.
But let me be the devil's advocate for a second, because cash feels safe. It's intuitive. I look at my banking app, and if I put $10,000 and that number doesn't go down, it stays $10,000. If I buy a stock or gold, that number could be $8,000 next week. That's terrifying for most people.
That is the power of the illusion. You are fixated on the nominal value, the number, while ignoring the real value, which is its purchasing power. Yes, the number on your screen says 10,000, but that 10,000 buys fewer groceries, less gasoline, a smaller fraction of a house than it did last year.
Its value is silently bleeding away.
It's the boiling frog analogy. The water temperature is rising so slowly that you don't notice you're being cooked until it's too late. The volatility of assets like stocks is scary in the short term, yes, but it's the price you pay for long-term survival. Cash offers the illusion of short-term safety in exchange for the guarantee of long-term destruction.
So the mindset has to shift from being a saver to being an investor, not as a way to get rich quick, but purely as a defensive measure.
Investing is no longer a luxury for the wealthy trying to grow their fortunes. It is a survival mechanism for the middle class trying to preserve theirs.
Okay, let's talk about the lifeboats then. The source lists 4 primary assets to escape the sinking ship of fiat currency: gold, real estate, stocks, and Bitcoin. I want to go through them, talk about the pros and cons. Let's start with the oldest one, the classic, gold.
The 5,000-year-old insurance policy.
Right. A lot of modern financial advisors will tell you it's a pet rock, it's a useless relic, it doesn't pay a dividend, it doesn't generate earnings. Why does this source recommend it?
Because gold's job isn't to make you rich. Its job is to make sure you don't become poor. It's not an investment in the same way a stock is. It's a store of value. It's the only financial asset that exists that is not simultaneously someone else's liability.
What does that mean?
Your cash in the bank, that's the bank's liability.
Yeah.
A stock, it's a claim on a company that has debts. A bond, it's literally someone else's debt. Gold is just gold. It has no counterparty risk. For thousands of years, in every society that has collapsed, when the currency goes to zero, gold is what's left.
So it's the ultimate disaster hedge.
It's your financial fire insurance. You hope you'd ever need it, but you're glad you have it when the house is burning down.
Okay, next up. Real estate. The classic middle-class dream. Buy a house, build equity. But right now, in most places, prices seem astronomically high and mortgage rates have shot up. Is it still a good lifeboat?
Real estate is fascinating because it offers 2 things that other assets don't. The first is utility. You can physically live in it, which has value. The second, and more powerful, is leverage.
You mean getting a mortgage?
Exactly. Think about what a 30-year fixed-rate mortgage is. It is one of the most powerful financial tools available to the average person. You are borrowing a large sum of today's money to buy a real asset. You then get to pay back that loan over the next 30 years with future progressively weaker and less valuable dollars.
So you're basically taking out a massive short position against the currency.
You're betting against the dollar. Inflation, which destroys the saver, becomes the homeowner's best friend. It erodes the real value of your debt while simultaneously increasing the nominal price of your asset.
The big risk, of course, is that it's not liquid.
Not at all. You can't just shave off a bathroom to pay for groceries. And if you lose your job and can't make that mortgage payment, the bank takes the whole thing. So it's a great inflation hedge, but only if you have stable income to service the debt. Don't over-leverage yourself.
Good advice. Okay, number 3, stocks. The stock market.
Stocks represent ownership in productive businesses. And businesses are resilient. They adapt. When their costs go up because of inflation raw materials, wages, What do?
They raise their prices.
They raise their prices. So their revenues and their profits go up in nominal dollar terms. And over time, their stock price tends to follow. Stocks are an inflation pass-through machine.
So it's better to own the company that's raising the prices on you than to just be the consumer paying them.
1,000%. Capitalism is a system designed to funnel wealth to the owners of capital. If you own the stocks, you own a piece of the machine. If you only have a job, you're just a cog in that machine.
And finally, the really controversial one, Bitcoin. The source puts this right alongside gold. Why? I mean, it's just digital code. It's invisible. It feels like pure speculation.
It is extremely speculative, no doubt.
Yeah.
But the thesis behind it is that it solves the exact same problem as gold, but in a digital way.
Yeah.
What's the fundamental problem with fiat currency?
The supply is unlimited. They can print as much as they want.
And what is the fundamental unchangeable feature of Bitcoin?
There will only ever be 21 million of them. The supply is fixed.
It's absolute scarcity, enforced by mathematics and cryptography. It's the first time in human history we've ever had an asset that is simultaneously digital, so it's easy to store and transport, and provably absolutely scarce.
It's the anti-fiat.
It's the ultimate anti-fiat. Now, the price is incredibly volatile because it's a new technology and the world is still trying to figure out what it's worth. It could go to zero. But the argument is, if the supply of dollars is going to infinity, what's the price of a truly scarce asset in dollar terms?
It also has to approach infinity.
That's the bet. But, and this is so important, the source is adamant on this point. Do not invest blindly.
Investing ignorantly is also suicide. That was the direct quote.
It's a great line. Do not listen to us get excited and go dump your life savings into some random crypto coin you saw on social media. That isn't investing. That's gambling at the casino.
You have to do the work. You have to understand why you're buying something.
Yes. Conviction comes from knowledge. If you buy Bitcoin and you don't understand the underlying thesis, what are you going to do when the price drops 50%, which it will?
You'll panic and sell at the absolute bottom.
You'll sell at the bottom every single time. You have to have the conviction to hold on through the volatility, and that only comes from doing your own research and truly understanding what it is you own.
This really brings us back to the psychological trap, the mindset shift that's required. The source talks about the nominal versus real wage trap, and this one really hit me.
It's the saddest part of the whole illusion, really. You go into your boss's office for your annual review. They tell you you've done a great job, and they're giving you a 5% raise.
And you feel great. You walk out of there feeling valued, feeling richer. You take your family out for a nice dinner to celebrate.
But if the real rate of inflation that year, the actual increase in your cost of living, was 10%, you didn't get a raise.
I got a 5% pay cut.
You got a pay cut, and you thanked your boss for it. And governments and corporations love this dynamic. It allows them to keep people happy with nominal gains, while their real wealth and purchasing power quietly decline.
It's what keeps the hamster wheel spinning. You have to run faster and faster just to stay in the same place.
And the only way off the wheel is to own the assets. Your salary is a stream of income that is constantly being debased. Assets are a store of value that floats on top of the tide of inflation.
So let's put this all together into a final action plan. We've laid out the problem, we've gone through the history, we've looked at the potential lifeboats. For the listener driving their car right now, what is the first thing they should do when they get home?
Step one is just to do a simple audit. Take a piece of paper and write down your net worth. How much of it is in cash or cash equivalents, like a checking or savings account? If that number is close to 100%, you're in the danger zone. You are fully exposed.
Now, obviously you need some cash, right, for an emergency fund?
Absolutely. You need 3 to 6 months of living expenses in cash. That's your shield. That protects you from having to sell your assets at a bad time if you lose your job or your car breaks down. But you have to accept that holding that cash has a cost. It's the inflation tax. Anything above that emergency fund is just melting. It needs to be put to work.
Okay, so that's step one. Audit and be honest with yourself. What's step two?
Step two is to start learning and then start diversifying. Don't go all in on one thing. Don't put everything into goals or everything into Bitcoin. The future is uncertain. A well-diversified portfolio of these kinds of real assets is the most robust strategy. The goal of Wealthnetic isn't to hit a home run and get rich overnight. It's to not strike out and go broke slowly.
And I think step three is really what we're doing right now. Education and spreading the word.
Yes, share this knowledge. The entire money illusion system relies on public ignorance. It only works if people don't notice that the ruler is shrinking. The moment you see it, the moment you understand the game, you can start to play it differently. You stop blaming the local grocery store owner for high prices, and you start protecting yourself from the source of the problem, which is the debasement of the currency.
And a good visual aid for this, as the source mentioned, is to actually go look at the charts on the Yi Raf Parue channel.
I highly recommend it. When you see the graph, that jaws of the crocodile gap opening up between the value of money and the value of gold, it's not an abstract concept anymore. It becomes visceral. You see your own wealth disappearing.
We'll definitely put a link to that in the show notes for everyone.
Please do.
Before we sign off, I just want to leave our listeners with one final thought to chew on. We've framed this whole deep dive as a battle, right? It's technology, which is deflationary and wants to make our lives cheaper, versus currency printing, which is inflationary and makes our lives more expensive.
It really is the defining economic battle of our lifetimes.
So the final question is, who wins?
In the very, very long run,
Yeah.
technology always wins. Human ingenuity is the most powerful force on the planet. But the transition period, the death of this current fiat money system and the birth of whatever comes next, that is going to be incredibly messy and chaotic.
Yeah.
And during that transition, there will be a massive transfer of wealth.
From those who hold dying currency to those who hold real assets.
Exactly. You just need to make sure you're on the right side of that transfer. Don't be the one left holding the bag of worthless paper when the music finally stops.
Build your ark now while the sun is still shining.
Or at least while it's only drizzling. Don't wait for the flood.
This has been a heavy one, but a really necessary deep dive. If you found this valuable, please subscribe to the channel. And more importantly, share this with a friend. Share it with that person in your life who's always complaining about the price of gas, but keeps all their money in a savings account earning 0.1%.
Gently, of course. But yes, wake them up.
Thank you so much for listening. Keep learning, keep questioning, and don't let the illusion fool you.
Stay afloat, everyone.